Okay, guys, thanks for coming out. Going to go through one topic today. I can pretty much guarantee it's something you've never seen before. We aren't going to be here to rehash something you already know. Call it hidden momentum, and I think that will be evident as to why we call it that as we proceed. Topics for today, market axioms versus market truths, which ties into exactly what we're going to talk about. So we'll just give it a little background on that. Then we'll talk about hidden momentum, why it's significant for your trading, and a simple entry technique to identify it and aid in your trade entry. Okay, how many times have you heard the phrase, trade with a trend, don't fight the tape? These phrases are always delivered with the best of intentions, but have they ever actually served any of us in taking money from the markets consistently? Well, if you're like me and probably a lot of traders I know, the answer is probably a pretty resounding no. That being the case, then, how have these cliches survived in market lexicon? Well, the answer is that while most of the time these axioms are wrong, there are a few times that they are spectacularly right. And the times that they are right is when the market is amidst such a powerful move that it's indelibly imprinted on our brains. And any attempt to go against such a powerful move, it results in a hard-to-forget trading lesson. On the other hand, the fact is that the majority of the time, most of the time, one can buy a dip and sell a rally and make out okay. Most of the time, the market's just backing and filling, even if it's within a trend, or even if there's a general directional bias, and you can buy dips and sell rallies. Certainly, probably 75% of the time, that's going to work out for you. So yeah, in fact, most of the time, the majority of the time, you can actually fight the tape and come out ahead, at least in winning percentage. Now, this leads to another market cliche that buying the dips in and out is akin to picking up quarters in front of a steamroller. And the message there is that, yes, most of the time, the higher percentage of the time, you will be successful, but be careful because you risk getting steamrolled in one of those infrequent but powerful trends. Okay, then, so how do we best make money in the market? Because clearly, those axioms aren't really helping us. Is all we are really left with a choice of buying dips and selling rallies for meager gains while hoping to avoid that major tsunami that wipes out all but a large chunk of our profits? Or do we wait for that powerful trend, and whilst we wait, we continue to watch our paper profits come back against us? That doesn't really seem like much of a choice, and it isn't much of a choice. So is there a way to change the game? Is there a way to take some of the high win rate of the steamroller trade and take advantage of the don't fight the tape spectacular moves? My answer is definitively yes. First, I'm not willing to give up on the high success rate. Taking profits and fueling your account is good for your dollar capital, obviously, and also your mental capital. Secondly, I'd like to take advantage, at least with partial positions, of that occasional tsunami move that always comes. And the key to doing this is watching for what we call signposts. Signposts are just what they say, signals from the market that give clearly measurable and quantifiable signals. The market has extreme momentum that's going to continue. They're measurable, they're quantifiable, and there's no ambiguity. What's even better is that the market can't move without giving you one of these signposts. Okay. Now, that's not to say that every time there's a signpost that the market's going to reward you immediately, because it's not, but the market really can't have a big trend without one of the signposts that we identify being present. Now, the basic principle behind all of this is, sorry, let me just go back here a little bit and say, how do we define a trend? Now, since we're talking about don't trade against the trend, well, one of the traditional ways, and it's not a very good way, is the market above moving average? Is it above the 200-day moving average? And I'm sure if you've been around the market at all, you've heard that. Well, the reason it's not very good is because, one, we all know that the market isn't trending most of the time, and two, the market is always either above or below a moving average. So if it's above it, you're going to say the trend's up, and if it's below it, you're going to say the trend's down. But on the other hand, we know most of the time it's not really trending at all. So that's really, it's inadequate. It's not horrible, but it's an adequate way to define the trend. So how do we do it then? We're going to use something that we call hidden momentum, which I'm going to show you exactly what it is today, or at least one way to measure it, and how you can use it in your own trading. Okay, what we're going to talk about here today, the basic premise of what we're going to talk about here today is that trends do not give up without a fight. Let me say that again. Trends do not give up without a fight. Okay, let's look at the basic principle of that. And to do that, we're going to create an analogy. That analogy is like, let's say that you're a shot putter and you throw the shot put forward. You're a person, you're just a regular guy, and you're throwing that shot put forward. Well, when it leaves your hand, it's moving forward, it's going in the direction you want it to go. In essence, it's above the moving average, it's moving forward, and all looks good. Now, what happens though, when it reaches peak momentum, very shortly after that, it's going to fall to the ground. And equity markets are much like that. So let's take that same cannonball, and if we stuff it in a cannon and we stuff it full of gunpowder and light the fuse, it's going to fly out of there with huge momentum. Now the difference is, when the cannonball reaches peak momentum, it'll still be going forward. If you remember your high school physics, it'll reach peak momentum long before it hits the ground. And stocks, Forex, futures, equities, ETFs, 1 minute, dailies, weeklies, whatever, it works the same no matter what. That principle holds. Now, it doesn't work every time because nothing works every time, but most of the time it works. So those are the kind of situations that we're looking to identify. Okay, again, trends do not give up without a fight. And this example applies exactly the same way to all financial markets. Okay, after the signpost of extreme momentum, and I'm going to show you exactly how that hidden momentum plays out in 1 second when we get to the charts. But that's only step one, because the market never works in if A, then B. You should all know that probably by now. It's never as simple as, if this happens, oh, then I'm going to buy and I'm going to make money. The market is like layers of an onion, and it's always peeling back one thing and then that and then the other. Okay, so oftentimes you'll need 2 or 3 or 4 things to happen, even if they're not happening all at the same time, to actually get you in a situation that you can quantifiably measure, test, and have confidence in that you're in a situation that's going to afford you a low risk entry. Okay. So after we have our signpost, which we'll show in the charts in a minute, then further along the time scale, the next layer of that onion appears. Okay, and that's how we set up a higher probability trade with potential. Now, we're not always looking for a big trade. We're looking for a trade that at least makes us money, but we'll be positioned if the trade turns out to be one of the tsunamis. Okay, so you can see that one of the important things here in peeling back that onion is that what happens 15 days ago may be more important. In fact, I argue is more important than what happened yesterday. And I think that's a concept that a lot of people don't really identify with immediately. Okay, but we're going to show you exactly why it's true as we get to the charts here. Okay, the concept's pretty simple. I don't think anyone's going to have any problems with it. There will be a scan with this that you can set up. It's very simple. I'll explain it to you. If you have any aptitude with Metastock at all, you can write it in 2 minutes after we're finished, but we will definitely send it to you in any case. Okay, so I'm going to go through the Dow 30 stocks here. And so it's a arbitrary group of stocks. It's not one that I've cherry picked or anything like that. It's the Dow stocks, and they are what they are. Okay, so what we have is just a plain bar chart here, and below it we have a 5-period RSI. Okay, you can go up here on your indicator and pick their relative strength index. That's Wells Wilder's 5-period RSI, and you just apply it. And my blue lines on the chart, the top one is plus 85, the bottom one is plus 15, and the middle one is just a neutral reading of plus 50. So that's all we need for what I'm going to show you for hidden momentum here. Now, if we go back to our shot put analogy, we want markets that are generating cannonball momentum. Okay, not shot put momentum, not shooting star momentum that's over quickly. We want to see something that's really showing us that there's some fire behind it. Now, traditionally, the RSI has been an overbought, oversold oscillator. Oh, when it gets high, then the market's overbought, and when it gets low, the market's oversold. And I think one of the things that I do well is I divorce myself from traditional thinking, because almost all of it, well, at least a large part of it, is wrong, to be honest with you. And I think this is a great example of it, because that's the exact opposite way that we should be using RSI. Okay, overbought and oversold are concepts that I question for sure. However, what I don't want to see, or what I do want to see, is this 5-day RSI get overbought. I want to see this thing over 85, and I want to see this thing over 85 for 3 or 4 or 5 or 6 days, within the last 15 days or something like that. Okay. So within a small period, if you can see where my cursor is here on the bottom left, right around the beginning of November, end of October, and we're starting off with Apple here for our first, you can see that RSI has generated enough momentum to get it over 85. And you can see just by looking at the history here, we've got almost a year of data up, that really happens. It really doesn't happen very much where you can get that RSI up over 85. But when you do, the red flag goes up, the signpost goes up that says, hold on, this market has a lot of momentum. Now, remember this, trends do not give up without a fight. Okay, I can't emphasize that enough, because it's the basis for everything that we do. So if it can generate that much momentum, once it consolidates or retreats a little bit, and it looks like it's doing nothing, it will try again, because like I said, trends do not give up without a fight. And remember our cannonball analogy, the market will keep going up long past peak momentum. Okay, so once it's generated that high momentum measurable by the RSI, what we're looking for is for somewhere down the road, is for a dip to get in, because we know that the market's at least going to want to try those highs again, or perhaps make new highs. Okay, now I'm going to give you a very simple way here, and I'm just going to say, if it gets back below 50 area, so it gets back towards the what traditionally be an oversold area, then you can start to look to buy. Now, obviously, when we have the trading course and stuff, and we have our indicators, they're a little bit more sophisticated than this, but I'm giving you the concept here, and I'm giving you something that actually has some merit to it, so you can understand the whole concept of hidden momentum and how it works. Okay. So again, if you follow my cursor right around here, we've got the high momentum because it's over there for 6, 7, 8 days or so. Okay. Then when we get down on these dips here is where we want to look to buy, because almost always it's going to want to test those highs or break those highs. Sometimes it's going to go off on a crazy tsunami, and sometimes it's just going to do this. But I'm not trying to chase this when the momentum is highest. I'm waiting for it to sort of consolidate or pull back a little bit, get my RSI back down into below neutral territory, then I'd be looking to buy. It's sort of like, to give you another analogy, if you're a predator in the jungle, as soon as you see your prey 200 yards away, you don't start attacking, you wait. Okay, and that's what we do here, we wait. So the reason we call it hidden momentum is because by the time it's here, the average investor is saying, oh, there's nothing going on. But there's tons going on because the important stuff happened back here, okay? And we have to be aware of that, okay? Again, it's back to the layers of the onion. The market is never what happened yesterday. It's much more sophisticated than that. It will divulge its secrets, but you have to know how to find them. Okay, so again, any more examples? Well, right here, we had a very sustained period. If you look at in mid-May or so in Apple, and then we got the dip down in here. Okay, so that's where you're looking to buy. Not much. You could argue here in Apple, again, middle of February, that may have been some negative momentum that it generated there. Now, obviously, it came a little bit past neutral, but still, even so. We came back down here a fair ways again. It had to retrench. That momentum that it generated on this move here that drove that RSI below 85 for a few days, it needed to come back and see, do I really want to be down there or not? And again, trends do not give up without a fight. Okay. Again, I'm not giving away for free the exact entry here, but you can see that somewhere in here would have been an okay place to sell it, even in a secular bull market like we have in stocks. Okay. And I'm going through these and I'm just seeing them at the same time you are, because I'm obviously looking at the Dow stocks. So it's an arbitrary portfolio. This one really doesn't have a lot. Maybe right here, possibly in this is American Express, and you've got your dip below 50 right here, but really not much going on there. What's interesting is that, it really is sometimes a market of stocks rather than a stock market, because you can, even though there's high correlations, you're not going to get the high momentum on all stocks at the same time. Now, here's the one right here where there's obviously high momentum, and then we get our dip down below neutral here, which is where you'd be looking to buy. Marginally here, we could argue that there's, again, the end of June here, we could argue that there's negative momentum. And again, you can see after the pullback, we wanted to come back and test again. Okay, lots of activity right here, obviously. This is Caterpillar, and we've got lots of momentum over 80. Now, again, the pullback was a little bit past neutral, actually got down below 85, which would be scary. So the only thing I would say about this one is when you look at this, the extent of that move there, you might identify that as more of a blow off than not, but that's kind of subjective. But in any case, even buying a pullback here, it did try to come back up. And again, that trend it's fighting. You can see that trend does not want to give up without a fight. Even if it is going to roll over, it will rarely roll over in a straight line. So if you're buying into that dip, you're at least going to get a chance to get back out because it won't give up without a fight. Negative right here in end of June, and you can see we get a rally, but it wants to come back and test those lows again because that momentum is still affecting the market. Okay, even though to the average investor, it doesn't look like anything's going on during this consolidation. If you know what to look for, you'll see that momentum, that hidden momentum that it generated, 6 weeks ago, is still affecting the market. Okay, really not much going on here. This one is Cisco. Maybe right here in late November, you could argue, but since then, really nothing. And, you could see the market's just a chop fest since then. Chevron, so we're in a whole different industry now. We got some momentum up here back in late September or so, or all through September. And then we got this pullback here, and of course, then you got your tsunami. Okay. Interesting here. Look how bad this decline was, but it really didn't drive the RSI down and keep it there. Okay, so this isn't even really, this would be what I would call a shooting star. It looks horrible, but it didn't really drive that momentum down and leave it there or keep it there for any sustained period or drive it below more than once. So I would not count that at all empirically as hidden momentum. And the rest of the time, nothing going on. And as you can see, nothing going on. It truly is a chop fest. Disney. This is one that on some of our other techniques that we use that basically follow the same principle of trends don't give up without a fight, that we are looking to buy Disney on this dip here. There's some momentum here, maybe not in this technique. Would you qualify Disney? Is there? There's enough. There's probably 5 or 6 days right there. So yeah, definitely there is. So even in here, you would be starting to get your first indications of a buy in Disney. And I know on our option service that we started in March, we're definitely looking to buy Disney there. So that's a good one to watch because, again, it shows how it is a market of stocks. If you look at the Disney chart compared to this one here, which is Goldman Sachs, there's a marked difference between how the two stock charts look. I would say we got some pretty good down momentum here. Look, it's down. It drives it below 15 here. It drives it below 15 here. And then for 4 or 5 days, it drives it below and keeps it there. And you can see Goldman rallied, but it just doesn't, that momentum that it generated at these RSI levels will continue to try to draw it back for at least attempt, okay? That's why you don't sell at these RSI levels. You wait. You see that the momentum is strong, and then you wait. And on the rally, you try to get positioned. Okay, let's see, what do we have here? This is Home Depot. Again, lots of tough stuff up here, over 85. And the dip was a little stronger than we would have liked, but again, that trend was almost a blow off. And so this would probably be the poorest signal we've seen today. Really, this attempt at a rally is much less than I would normally expect. So like I said, nothing works every time. Good example. Since then, really not much going on with Home Depot. Here maybe, okay? And then you did get the next attempt and you did make a marginal new high. If anything, you know, I wouldn't be surprised to see Home Depot try the top again sometime in the next little while. Okay, IBM. Not much either way here over here, but again, that's that blow off top in early 2018. That was almost, like I said, more blow off than momentum. I think it's interesting to see the ones that have generated some downside momentum and how even in this bull market near all-time highs that they've continued to foreshadow that the rallies are going to be sold. Again, lots of momentum here, and that really foreshadowed this whole thing right here. Okay, what have we got here? Johnson & Johnson. This is probably my last one because I think everybody gets the idea. What I would like to see is one more that has the down momentum on it because it almost illustrates the point better because it's so counter trend. Okay, here we go. This is Coca-Cola. You can see here, okay, we get below for 5, 6, 7, 8 days in a row here, okay? And then we rally back up here. You can see it wants to come back down and test those lows, okay? And this was within a bull market, okay? So the principle works both sides of the market, and obviously, it's going to work better in a secular bull if you're buying and in a secular bear if you're selling, but it works both sides of the markets, and the concept's fairly simple or very simple. Here's a big one here. We've got a whole ton of activity below 15 in the RSI, and when it rallies, it hasn't done anything. If you look at it compared to the general market, it's been exceptionally poor. Okay, so I think that cleans up the concept of hidden momentum and how we use it. Again, I think it's kind of a neat thing to realize that what happened a few weeks ago may be more important today than it even was a few weeks ago, or certainly more important than what happened yesterday or the day before. And that's something that I don't think a lot of people realize, and that's why we call it hidden, because it's not always obvious. Okay, let me go back here and just clean a couple things up. In terms of finishing up, and then we'll entertain some questions on anything that you wanted. So we use the RSI. Okay, so where do we go from here? Well, you've been introduced to the principles of my most important market axiom, which is trends do not give up without a fight. You've been introduced to a simple way to see how that axiom works in real time using actual indicators that you can measure and quantify. Now, the course that Hunter will talk to you about in a few minutes is actually a lot more sophisticated and detailed. It contains proprietary indicators, and it has a beauty of a little system that runs mechanically and has one of the smoothest equity curves you'll ever want to see, and that runs on the system tester, so there's no interpretation whatever. It just gives you the signals. So what does the trading course include? Well, it includes proprietary technical indicators, like I mentioned, that short-term daily swing system for stocks and S&P, and the section on don't yawn, but managing your trades. I know everybody, it's cliche almost, and people don't want to hear about it, but I think that you might be pleasantly surprised by what you read, because I think, again, just like we talked about with market axioms at the beginning here, what passes for undisputed knowledge in this area of managing your trades is not what works for me. So you will see stuff that you probably won't see written somewhere else. And perhaps the most important section of all is a discussion of why we make trading so hard on ourselves and what we can do about it. We've all been through it. You know, why did I do this? Why do I keep making the same mistake? How can I be so stupid? And we beat ourselves up. Okay, but we've learned so much about neuroscience and how our brain actually works that you'll be happy to know that everyone's doing the same things you are. Okay, but once we're able to stand outside and say, okay, now I see my brain's wired to do this, and I can actually be on guard for it. Oh, and I also know what I need to do to manage that when I am on guard for it, then we can start to actually burn new neural pathways in our brain that will change our behavior. But sitting there saying, why do I keep making the same mistakes? Why am I so stupid? I'll never do that again. And we've all been through it. If you read, you know, a book like Marty Swartz's, Top Traders book, everyone's been through it. So it's not you. It's all of us, and we've learned so much about neuroscience in the last couple of years that its application to trading is huge. Okay, and lastly, the trading course includes instructional videos, 10 of them, that illustrate everything, and they include actual trades using what I'm teaching you, and they're linked to brokerage statements so you can see that, yeah, this is what I'm doing. Okay. On the web, Joe at jdtradingsystems.com. jdtradingsystems.com is obviously the website. You can email me with questions about the training course, the options advisory and its track record, and any and all questions about this or anything else. I'd be more than happy to answer them. The course is $1,000 on the website. I know Dwayne's going to offer, Hunter's going to offer it for substantially less today. So that's all I have. If there's some questions, I guess going to have to get back and see if Hunter's got any, or if there's any on the site here I can see. And otherwise, that's it for me. So I'm going to just mute my microphone, and I'm going to let Hunter come back in.
Wonderful. I appreciate it, Joe. And we're going to get back with Joe here in just a moment, because I have a couple of questions that we have a couple of questions from people in the webinar right now, as well as I have a couple of questions for Joe, just to kind of illustrate, what we're trying to do here. Now, Joe mentioned the educational course, and just to give you a little background here, Metastock, obviously, we've been in business for over 30 years. We've been the #1 technical analysis platform for over 23 years. We've been working with professional traders for 30 years, and our clients know that it's probably one of the best, if not the best, technical analysis platform out on the market. But at Metastock, we understand that having tools, I mean, that's a wonderful start. Having the education to back up those tools and understanding how to utilize those tools is really what's going to take your trading to the next level. Therefore, we have just launched the Metastock Enlyten education program. And we're very happy to have Joe as one of our first educators through this Enlyten program. And our whole goal and focus with Metastock Enlyten is to not just provide you the tools and the systems that these professional traders are using, but on top of that, we really want to get down to how they are using it specifically. We want to have these educators walk you step by step through their trading methodologies, not only with their different signals, with their expert advisors, with a webinar here or there, but a specific organized course to walk you through from A to Z what their methodology entails. We know that education is a very, very important part of your trading, or at least it should be. As traders, we should always be open to new philosophies. And when looking at Joe's system, specifically, I want to not just have to depend on looking at our expert advisor or using one webinar or understanding one of his techniques. I want to have more of a hands-on feel, and I want Joe to be able to walk me through exactly how to trade his philosophies. Now, since it wouldn't really be cost effective or a good use of time to fly Joe out to all of our clients that want to use his system into his house or into their house and have them sleep on their couch, we wanted to be able to sit down and organize an entire course around what Joe does, and that's what we've done for the first time here with Metastock Enlyten. What Joe's course comes with is quite extensive. We've wrapped up his entire Scoop add-on, the methodologies that he uses, and we've put it into a 5-module training program. And in this program, he's going to break down the ins and outs of all the systems, very, very easy to use format. You're going to have all of his signals as far as his explorations, his templates, his system tests, etc. And what I really think personally is that having these different modules to walk you through every single piece of his trading methodology is going to be one of the most important things that you can have. Now, with this course, we've made it really, really easy to use. Just like using Metastock, downloading Metastock for the first time or downloading an add-on for the first time, it's right there on your metastock.com account. Okay. Now, one thing actually, before I get to kind of what all is included, I wanted to have a little bit of dialogue with Joe here and ask him a couple of questions to help shed a little light for all of us as to kind of why he did it and what he thinks the shining points of this educational system is. So first off, Joe, why do you think that education is so important in trading?
Okay. Well, let me go back to when I started. It was the 80s, and there was a book out that had pretty much changed the whole face of technical analysis, and it was Wells Wilder's book, and it was called New Concepts in Technical Trading Systems. And we'd gone from pencil and paper and drawing lines to this whole, really the start of algorithmic trading, really. And I can remember going down to the Tandy store, if you remember Tandy, and buying a personal computer and having a kid from the university program it for me, and then taking all the output and drawing it on this giant graph paper that I'd got from the drafting store. So that was the start of my, journey. And I can tell you this, without Wells Wilder, boy, I hate to say where I'd be. And then I got into a guy named Gerald Appel who did a lot of the same stuff that was more towards the algorithmic side. We were actually measuring stuff and actually doing stuff quantifiably. The stuff that those people taught me, from where I would be without that, if you just said, here's the prices, go at it, it really, you can't even measure how much that put me on the path to, you know, success, really. And I think that the fact that they had to really think outside the box in order to do some of the things that they were doing, and I think my mind kind of works like that anyway, it really allowed me to question some of the stuff that, you know, I don't believe is true. I think there's a lot of sort of common knowledge out there, you know, about trading that's really disingenuous or you know, harmful, actually. So we get into some of that in the course too. But so, yeah, I think that's where I started. So for me, that education was important. And I think too, and, you know, people may think this is disingenuous, but I can guarantee you it isn't. When you teach, you learn. And when you're trying to give something back, you're trying to help somebody, it all comes back to you. I think, you know, we talked a little bit about something that I've become very interested in the last couple of years, which is neuroscience and how your brain works. And it's interesting that, to me, that a lot of things that I thought, and most people did say, were pop psychology, you know, in the 90s or whatever, when Wayne Dyer was talking about them or stuff. Now, actually, we find that when we study neuroscience, actually a lot of the stuff he's talking about is actually how our brain actually does work. So when you are teaching, you are learning, and when you are giving back, it is coming back to you. So, so I think for those two very important things, that one, you need education, because if you just threw the prices out and said, go to it, where would we be? It would be a really tough slog. I know I wouldn't be where I am. So I hope that's not too long an answer to a simple question, but once I get going, that's my answer.
Yeah, no, it makes total sense. And just to kind of weigh in on that, with education, it's not just one-time education either. It's continuing education. You know, if you look at people that are masters of their trade, if you're a doctor, there's always continuing education and certifications that you have to do. If you're a financial advisor, it's the exact same thing. So if I'm looking to learn from someone, I want to go to a professional. What does a professional do? They always continue learning. Now, if we apply that that methodology into trading, the markets are always changing. And if you're a trader that is stagnant or stuck in a rut, you're not going to make as much money. You're not going to be able to take those profits, you know, your profits to the next level. So I think that the value of education is incredible. The value of new education, new knowledge is something that will benefit you no matter what industry you're in. Take a question from the audience here. The system, it works with, let's see, just pulling up the questions here. Okay, does the system work with end of day and real time, or does it work with one better than the other? Joe?
End of day. I've ran it on real time, and I've seen it work on hourlies for like, whoa, this is great. It'll work for months and months and months, and then it'll run into a drawdown, to be honest with you. Whereas the end of day, yeah, obviously, because the reason is because the hourlies can be obviously much more volatile, and you can get longer trends that don't really amount to anything on the daily chart, but amount to a lot on the hourly chart. And if you're trying to buy dips, which is what it does, or sell rallies, which is what it does, it can be it can work on the hourlies, but once you get into some sustained business on the hourlies, it can you know, hurt you a bit more. So yeah, I've looked at it in the hourlies, and it'll go months and months and months, and it's killing it, and then it'll go a couple months where it is getting killed. But on the dailies, it's got a remarkably smooth equity curve, and you can look at it across a lot of different stocks as well as ETFs. I think one of the ways, interestingly, that I found to test systems as I've progressed, and this is kind of a tangent, but it might be of interest to some of you. If you run a system test on the S&P 500, one of the best ways you can test it to see if that your results actually have any meaning is to say run it on the Dow 30 stocks, run it on all 30 Dow stocks, and if it's not making money on most of those, then you've probably over optimized it. Okay, and you'd be surprised that that correlation isn't as high as you may think. And you're always going to have some deterioration when you run it on individual stocks. But if that deterioration isn't too bad, then you probably have yourself a good system, and that's what this does. But yeah, it's designed for end of day. Sorry to be off on that tangent, but you can look at it for hourly charts or intraday charts, but beware that the lower time frame you go, the more noise there is in the market.
Okay, and another question from the audience. The RSI blue lines that you were using, actually I can answer, I believe it was 85 for the high, 50 for neutral, and 15 for low. Is that correct?
That is absolutely correct. No magic of those, but those are pretty good parameters for a 5-day RSI. Yep.
Okay.
And it's the principle too.
Do you take volume into account when using the RSI?
I don't. I've tried to work with volume before, and boy, like I know some people put a whole lot of weight in it, but here's my experience with it, and I'm not going to say I know for sure that some of the things that I say, somebody else could have a different view because they've done more work with it, and they would be right. Okay, just like I know that some of the things that I do, people say, well, that will never work. You can't do that, or blah, blah, blah. Well, there's nothing, I think, as Elon Musk said, there's nothing more fulfilling than knowing absolutely something that everyone else says can't work. Anyway, so my experience with volume is this, and it's just mine, okay, and I haven't done as much work with it as someone else, but we can have a stock that goes up on low volume, and you could argue that, well, it didn't take much volume to push that up, it must be bullish. Or you could have a stock that goes up on high volume, and you could argue that, well, look at all the money that came in there to push that stock up, it must be bullish. I haven't seen a correlation, and again, maybe because I'm looking for correlations that, well, if A then B, which almost never works for a sustained period. Maybe I haven't done enough work with volume, but I could never figure out a way to peel back the layers of it. Maybe that's a better answer. So I don't really look much at volume, honestly.
Okay, wonderful. And last question for you here, Joe. What are some of the highlights of your course?
Well, like I said, I went through the 5 sections. You've got the proprietary indicators, you've got the scoop, you've got the beauty little S&P system, which just spits out mechanical systems without any, judgment. There's lots of stuff with the proprietary indicators that it's way deeper. When we talk about peeling the layers of the onion, it's way deeper. Even though it uses the philosophy we showed today, I can guarantee you 100% that there's lots in there that you've never seen or thought about before. And again, the section that I said, don't yawn, but it's managing your trades. I've got some thoughts in there that are completely opposite to what you may have been taught or heard or passes as traditional knowledge. So I don't think it really is a yawner. And probably the most important section, like I said, we've learned so much about neuroscience and how our brain works in the last few years. And that has huge applications for our trading, because trading is the exact antithesis of human nature. And so once you understand how your brain wants to work, you can actually start to stand outside and see, okay, it's doing this, and have some ready-made remedies so you can sort of head it off at the pass, because it really just wants to do what it's always done. I can't get into the neuroscience of it too much right now, because it's obviously a big topic, but just understanding it and it's pretty much the same for all of us, and we all have to overcome the same things, is big. Don't beat yourself up by saying, why do I keep doing this? Why do I keep making the same mistake? Well, because that's the way all our brains are wired. But there are ways to combat that. And again, the last section has, all the instructions tied together, tied to actual broker statements, tied to actual trades. So you can see that what we're doing is actually being used to trade real money.
Yeah, and in, kind of summation from our end, I'd like to thank Joe because he's put in a lot of work with actually structuring this course and putting together the modules and the extra manual that comes with it and really making a pretty in-depth philosophy very, very easy to use. So if it's something that you have some interest in, here's the thing: is you can have the best tools in the market, and I'm totally biased, guys, but I think that Metastock really are some of the best tools on the market. You can have the best tools, but if you don't understand how to use those tools and apply them to your trading, in all honesty, I really think that you're missing out a little bit. So in combining Metastock and Enlyten, this new educational course, this new push for education and knowledge and learning really from the experts that are putting these systems to use every single day, combining them with combining the tools with that education is something that's really invaluable. But with this, we wanted to give you the opportunity to take this course at a discount. I know that Joe lists it at $9.99 on his website. What we would do is we would combine the add-on as well as the 5-module course, and we'll do it at a discounted price of $5.99. Like I said, if you're wanting to learn from a professional, learn multiple different strategies, even money management rules, etc., this is definitely going to be a course that will make you money, in my opinion. There are a couple of different ways you could take advantage of this offer. First off, you can give us a call at 801-506-0900. Put a +1 in front of that for our country code if you're outside of the States. You can come into Metastock chat right now, metastock.com/sales chat. Just tell them that you were in the webinar and that you're wanting to take the course, and they can give you that discounted price. You can also go online to metastock.com/Duffy A, and you can order it online at that discounted price. One thing I definitely want to do, again, Joe, I wanted to really thank you for all your work on this. I think that you've done a wonderful job in taking your philosophy, not only putting it as an add-on in Metastock, but also structuring an entire course around it. So I definitely want to thank you for that.
My pleasure. Thanks. It's great to work with Metastock, and like I said, I use the software all the time, and thanks.
Wonderful. And again, thanks for the presentation today. If you guys in the audience have any questions, feel free to come into chat, or Joe put his contact information up a little bit earlier. Go ahead and come on into chat if you have any questions, or if you're looking to take advantage of this offer. Thanks for the presentation, Joe. And thank you everyone in the audience for coming and listening to us for the last 45 minutes. Hope you have a good evening, and as always, happy trading.